We'll start the presentation in about 2 minutes. So, everyone get comfortable, get your notepads ready, and we'll start soon. We're starting the presentation in about 30 seconds, so get your notepads ready. Thank you for joining us today. I'm honored to introduce your presenter, Tim Wood, founder and owner of the Plan Advisor, which serves the retirement needs of clients nationwide. His company was founded on the ideal of education first, which is one of the reasons Tim became a certified financial fiduciary. As a fiduciary, he always puts the client's needs first in all situations and is completely independent, not answering to any insurance company. He is also the host of the weekly on-air radio show and podcast, Safe Money Retirement Radio, where he is able to use his years of experience to educate retirees about ways to protect their hard-earned retirement dollars from losses. He also shares his knowledge as an invited author on Think Advisor, where he helps other advisors nationwide grow their practice and make the best decisions for their clients. Ladies and gentlemen, here is Tim Wood.
Thank you, Jimmy, for that great introduction, as always. Welcome, everyone, to another Safe Money Retirement Webinar. Hope everyone is doing well this evening. I know you can't really see it. I've got my flag pin. Anyone out there that's a veteran, thank you so much for your service. Heartfelt thanks for me and everybody else. It's very important that we recognize your sacrifice and everything. So thank you so much if you're a veteran or if you're a family of a veteran or whatever, because you certainly sacrificed a lot as well. So hello and welcome everyone to our required minimum distributions webinar this evening. I'm very happy to be here. Looks like another pretty full room. Let's see, we've got people from all over the place. I'm seeing several from Texas, Tennessee, Virginia, New Mexico, seeing all over the place. How is everyone doing this evening? Hope everyone is doing well. We have got a pretty full slate tonight. It's going to be a pretty full webinar. We've got a lot of stuff to go over. So one real quick thing, I want to mention the chat box. You'll see the chat box there on your screen. Now, I've got it set to private, so I'm going to be the only one that will see your questions. So do me a favor, and at some point, please send me a chat with what your number one question you want answered is. And at the end, I'm not going to have very long. There's not a whole lot of time after these, but I'll have 5 or 10 minutes to go through and pick some of those and get those answers for you right now. All right, we're going to cover a lot of different strategies when it comes to RMDs during this webinar. So get your notepads ready and let's go ahead and jump in. All right, I always like to start with a personal story, and this is a true story. And if you've seen any of my webinars before or my podcasts or anything, you've heard me talk about this, but it's important. This is my dad, Leon, back in the early 80s. Now, he's, I think, a great man, very hard worker, always provided for his family by working his tail off like most of us. Like many of you, he worked for many years for a company, and he wound up with a substantial amount of stock that he was planning on using to fund his and my mom's retirement. Well, here's what happened. After working hard all those years, he finally got to retirement and was ready to put all that stock to work for him in retirement. But within 4 years of leaving that company, 4 years, the value of that stock he had accumulated over the years had dropped by over 75%. That's 3/4 of his retirement savings gone because of market volatility. And we're not talking about a small amount here. I'm not going to say how much, but we're talking in the 6 figures he lost in less than 4 years. So helping people protect what they've worked their whole lives for is very personal to me. I've seen the effect a market downturn can have on someone's retirement firsthand. So I've made it one of my goals to help as many people as I possibly can protect their retirement savings from market losses. Now, I have one more quick story about RMDs and what will happen if you're not ready for them. I like to express things through stories. I think it's a good way to teach this type of material because it's not very fun. There was a client that I was working with a while back, and I'm going to change their names and call them Mr. and Mrs. Lee. Now, Mr. and Mrs. Lee had about $750,000 spread between multiple different retirement accounts. So they had a pretty good nest egg that they were going to use to fund for their retirement, of course. Now, everything was great until they reached that magical age where they had to start taking RMDs. It was 70 and a half then, it's 72 now with the new laws. And they assumed their current companies would automatically take out their RMDs so they wouldn't have to do anything. Now, I bet you know where this story's going. Many types of retirement plans won't just take out your RMDs automatically unless you tell them to, and tell them how you want it done as well. So what happened? Their RMDs on that 750, which came to about 30,000 or so, didn't come out when they were supposed to. And when that happens, you get charged a 50% penalty tax. 50%. It's the largest tax penalty out there, and unfortunately one I see all too often. They came to me for help after the fact, and I was able to help them, move forward, but it was already too late because if RMDs don't come out before the deadline, you will have to pay that dreaded 50% penalty plus the original RMD that you missed, which actually pushes you closer to getting a 75% really, but that's neither here nor there. As you can imagine, they were desperate for help and answers. I was able to help them avoid any more problems moving forward, but that didn't stop them from having to pay the penalty from what had just happened, from what they had just done. So don't let this happen to you. Make sure you make yourself a note to make sure your RMDs get taken care of properly and on time, every year. If you're set up in the right type of account, your RMDs can take care of themselves, but unless you know for sure, check it. It's on you. All right, we are here tonight to discuss required minimum distributions. Did you know that should you be blessed enough to live to age 90, there's a decision that you could make now at this stage when you're getting ready to take required minimum distributions that could mean the difference between having your entire IRA intact over the next 20 years or maybe having as little as only a third of it intact over 20 years. And we're going to look at that in a few minutes. We'll discuss this most critical decision that you can make as you get close to taking RMDs to make sure you avoid that dreaded 50% tax penalty. So because of that, this evening, we're going to address 5 specific things that I know are huge questions for most baby boomers that are getting to the age of required minimum distributions. Now, it still sounds a little funny to me to talk about baby boomers and required minimum distributions in the same breath, but right now we've gotten to a point where baby boomers are beginning to take those RMDs and actually have been taking them for a few years already. So the first question is, how do I calculate my RMDs? We're going to look at that. Then we'll look at how to calculate how much additional tax is due on those RMDs. Number 3, are there any tax saving strategies that I can utilize to partially or wholly offset the additional tax? Number 4, what do I need to know about beneficiary designations and how might that be different from other accounts? We'll look at that. And last but certainly not least, we'll look at how do I know if my asset allocation is appropriate for required minimum distributions. We're going to go over all that and more this evening. Before we jump in, a few housekeeping items real quick. This is a live event this evening. So because the decision that you make now could be the difference between keeping your entire IRA or retirement plan intact versus maybe only having a third of it intact over the next 20 years, I encourage you to stay focused for the next 30 minutes or so. That means not answering any phone calls, Xing out of any other tabs or programs you may have open, but also because this is a live event, like I mentioned before, I encourage you to type in the chat section whatever questions you have on your mind. Like I said, I've got it set to private. Nobody else is going to see them but me. And I won't say who you are when I answer it. I'll just say what the question is. Towards the end of the workshop, I'll have a little bit of time to address as many of those as I possibly can. And if you stay until the end of the workshop, we actually have a special offer for you. Basically, all the information that you're going to get tonight, all the answers to those 5 questions we just had on the screen, and everything else that we're going to cover is good textbook information. It's good general information. It's stuff everybody needs to know. But it's not specific answers for you at your age and your particular circumstances and everything about you. So if you stay until the end, you're going to be eligible to receive a special analysis, and it's what we call our RMD analysis pack. This will answer those 5 specific questions for you specifically and in your specific situation, regardless of how much money you have in your retirement account, regardless of your age, and so on. All right. Let's start with the question I hear all the time, and that is, why do required minimum distributions exist in the first place? Well, the government years ago decided that they wanted to entice you to start saving money for retirement so that you wouldn't be completely dependent on them. And I think everyone here can agree that it's never a good plan to totally depend on the government. So they gave you tax incentives to save. They did this by giving you tax deferral on your growth. This allowed you to put your money away pre-tax every year, and this includes your 401k contributions, TSP plans, 403bs, 457s. There's multiple different plans, but you know if you've got a pre-tax plan, and that's where these came from. The government gave you that incentive, but at some point, the government wants its cut. Remember, this is an incentive for retirement. This isn't an incentive for you to live to be 100 years old and pass that money to your loved ones. They want to make sure they get taxes on it during your lifetime. They want their cut, and they want it sooner rather than later. So as a result, they've created these required minimum distributions, or RMDs. They're amounts that you have to withdraw from your IRA or any qualified or pre-tax type of plan that you may have. I'm going to take a little side note here. I get a lot of questions about what does this qualified thing mean I see on my statements. Qualified simply means it's a before tax type of plan, like a 401k, 403b, TSP, and there's multiple others. Another way to look at it is it's a plan that still needs to have the taxes paid on it. It says qualified, which means it's qualified to be taxed. That's all that means. Now, the good news is they don't make you completely take the money out so you can start paying the tax in little bits and pieces. They don't make you do it all at once. In fact, they want you to do little bits and pieces, not all at once. Now, the old rule was age 70 and a half when you had to start taking them. Now, don't ask me why Congress would come up with an age like 70 and a half, but don't ask me why Congress comes up with a lot of the things they do. But the Secure Act of 2019 moved that age to 72. So now the starting age is 72, and at 72, you've got to start taking out little bits and pieces and paying taxes on those every year thereafter. And you'll see in a moment, the amount you have to withdraw increases each year on a percentage basis as you advance in age. So that's the spirit of these required minimum distributions. Some people think, man, when I turn a certain age, I've got to take it all out and pay taxes on them. No, you do not. The government doesn't want you to have to pay taxes on all that money at once and not have money left in case you need it. They just want to make sure they start getting their tax money at a reasonable age. And again, now that age is 72. Now you've got to make sure you don't miss this once you turn 72. This is the number one mistake retirees make, and it's the biggest tax penalty out there. If you don't take out your RMDs on time, you will be subject to a 50% tax penalty. So make absolutely sure you don't miss your RMDs. And when we do your personalized analysis, we can look at what you've got and make sure you're all set so you don't have that penalty. Okay. The Secure Act of 2019 came into existence in December of 2019 and was effective January 1st, 2020. Now, this was the first major piece of legislation we've had in over a decade when it comes to our retirement. The first thing that it did for us was give us new rules for IRA owners. Now the rules are as follows. It eliminates the 70.5 age barrier limit from making traditional IRA contributions. Not a bad thing. It means you can contribute longer. It also increased the age to start taking RMDs or required minimum distributions from 70.5 to 72. So now we can wait longer to take out distributions. Another thing that's not bad. Then it made some real big changes to our beneficiaries. This is the part under the surface that a lot of people don't understand. The old rule was that children and grandchildren and anybody else that got this could spread the distribution and taxation over their entire estimated lifetime. But they did away with that. The writing is on the wall, and we all know the government wants their taxes and they want them paid sooner, not later. So here's the new rule. Children, grandchildren, nieces, nephews, cousins, any other non-spousal beneficiary must pay taxes no later than 10 years after they inherit. So again, the new rule is all non-spousal beneficiaries must pay the taxes due on a traditional IRA or 401k or that type of a plan, TSP, there's a bunch of them, within 10 years. Okay? Now, what are the options for the beneficiaries once they get that? They can liquidate the account immediately and pay all the taxes due. A lot of people do that. It can really make a big impact on your income because all of that is going to be counted as regular income and it can really kick you up in income tax brackets. So be careful of doing that. The second option is they can spread these distributions out and pay taxes over 10 years, kind of like a pay-as-you-go plan. And this is really what makes the most sense for most people, not all the time, but most people. Or they can wait until the 10th year and take out the distribution and pay a lump sum at that time. The good thing about that option is you're letting it just grow the whole time, but then in that 10th year, you're going to get pounded with all of it all at once. You're going to pay all that tax at once, and it's all going to look as regular income, so it's going to kick you up in tax brackets. So you got to be careful of that stuff. That's the kind of stuff we have to watch for. All right. That covers new legislation, so let's get down to it and look at exactly how you calculate your RMDs. Now, the first thing you have to do is go to a table. It's the IRS Uniform Lifetime Table. If you want to look this up yourself, write this down. It's actually called IRS Pub 590 for publication, PUB 590, Pub 590. So if you just type in IRS Pub 590 in Google or whatever you use, this is going to come up and it's going to look just like this. So this gives you an assumed life expectancy at various ages. It's similar to an actuarial table that a life insurance company would use to determine your rates and life expectancy. It's similar to that, but let's look closely at this. Let's look closely at age 72. You'll see that your life expectancy at 72 is 25.6 years. Now, wait a minute. Let's think about that for a second. For those of you that are pretty good with math, you know that means a 72-year-old on average would be expected to live all the way to 97. And you know that 72-year-olds on average generally aren't going to live to 97, right? So why do they do this? Well, the reason is just like I said a few minutes ago, They want to make sure you don't run out of money in retirement. So as a result, they make the required minimum distributions smaller and assume a longer life expectancy than you actually have, statistically speaking. How do they do it? They assume you're 10 years younger than you actually are. So if you're 72, they're essentially assuming you're 62. And at 62, you've got a pretty good chance of making it another 25.6 years. Actually, that's exactly what the average expectancy is. So as you can see, the life expectancy gets a little shorter every year that you get older. You can see that, and that just makes sense. So the first step to calculating RMDs is to look at that IRS. Again, it's called Pub 590. The second step is to do a little math. So your required minimum distribution is simply the amount of your IRAs or any other pre-tax accounts, whatever it is, 401k, for TSP, whatever, at the end of the previous year. You divide that by the number on this IRS assumed life expectancy table. The result will be the amount that you have to withdraw and pay taxes on for that year. Let's look at another example. We're going to use round numbers through this whole thing to make it easy. So we're going to say you have $100,000 in an IRA. So if you were to divide that by the age 72 life expectancy we were just looking at of 25.6, do the math. That means you have to take out $3,906 that year, which is just shy of 4% of the balance. Now, if you look on the right side of the screen, you'll notice your life expectancy goes down by less than 1 year for every year you get older. That's because they have to figure in some people live past 97, right? So that's what they're figured in. That's why it's less than 1 year for every year that you actually age. All right. Now, how do RMDs work with 401ks you haven't rolled over yet? Big question. Here's where it really starts to get tricky, because the government doesn't make anything easy. And unfortunately, all of our mistakes many times benefit the government. So pay attention and let's not make any mistakes on this. Let's do another example, since that's a great way to learn this stuff. Let's say there's a 72-year-old with a total of $1 million in savings. That's their entire life savings is $1 million. It's a nice round number, easy to work with. And like I said, we're going to keep working with round numbers just to make things simple. Now let's assume on the left side of your screen that 72-year-old has $500,000 in 2 separate IRA accounts, split at $250 each. Once again, we're going to use round numbers. So with a 4% RMD on the $50,000, that's $20,000 a year. Easy math, right? In this case, we did take $10,000 from each, but you can take that from any of the accounts. You could take it proportionally from each one, or you could box it up and take it all from one. You could take all $20,000 from one of those IRAs. It's totally up to you, because all of that money is in an IRA. The government doesn't care where your RMDs come from when they come out of an IRA account. But again, that's from the IRA portion. How about the rest of the money that they had in other accounts? Well, if you look at the right, got another $500,000 of which RMDs are due, and same 20,000, but this $500,000 is not in IRAs. 250 of it's in a 403B, and 250 of it's in a 401k. And by the way, if you don't know what a 403B is, don't worry about it. It means you don't have one. Basically, a 403B is very similar, almost just like a 401k. It's for teachers, certain medical professionals. There's also 457 plans that are much like this for state and municipalities. There's multiple ones, TSPs. There's all kinds of ones, but they all work the same. In this case, you've got, basically you say, okay, I've got 500,000. Can I take it all from one account like I can with the IRAs, or do I have to take 10,000 from each one? Well, with these types of accounts, you cannot commingle them at all. In this particular case, because this money has not yet been rolled over to IRAs yet, you have to take the RMDs attributable to each account from that particular account. The government has basically built a firewall between 401ks, 403bs, and those type of plans and IRAs. So one of the things that most people strive to do is before they get to RMD age, which now again is 72 or shortly thereafter, they want to basically take their money out of these plans and roll them over to IRAs so they have complete control over their money. Now, this is just a general rule because when you roll them over to IRAs, you have much more flexibility. Not just more flexibility in terms of being able to commingle and take them from various accounts, but also the flexibility to have a wider variety of investment options to choose from. Let's say this 401k is limited to various mutual funds. Well, when you take a withdrawal from a particular 401k, not only do you have to take the withdrawal attributed to each account from that account, but moreover, when you take it out of a particular 401k, you can't pick one fund to take it from. It comes out of all the funds across the board, the ones that are doing great and the ones that are doing sorry. It comes out the exact same all the way across the board, so it doesn't give you control over where it comes from. So again, one of the main reasons retired people strive to roll over these accounts to IRAs is that you cannot commingle them or select exactly where the money is coming out of for these types of accounts. So in summary, the accounts where RMDs have to be calculated and taken separately include 401ks, 457s, 403bs. And like I said, there's a few others. And the only ones that can be taken either separately or together are your IRAs. There's just much more flexibility on the IRA side. So again, you're probably thinking, gosh, this is easy. It's simple math. Well, it's easy on the surface, but remember, retirement planning is kind of like an iceberg. There's always a lot more under the surface that you have to be concerned about. It's also kind of like what they say about pressure. Pressure creates diamonds, but it also floods basements. So you're definitely going to want to take us up on that special offer at the end. If you still have money in these types of plans that you haven't rolled over to an IRA, so we can look and see what your best options are so you stay in control of your retirement money. All right, now this is one of the most important pieces of information you're going to see tonight. Hopefully all of you know this. RMDs were not required in 2020 because of the virus, but they are back for 2021. So do not miss them. If you do, you'll be subject to that dreaded 50% penalty we discussed earlier. Please don't let that happen to you. Okay, next, you're probably wondering, how does taxation work on these RMDs? All right. First of all, RMDs come out and they are 100% taxable as ordinary income. So again, they are not capital gains, they're ordinary income. That's how it's going to be looking on your W-2 when you do your taxes. It's ordinary income. Now, the one exception is if you have some after-tax money that got put in, then the money comes out on a prorated basis. So what I mean by that is, let's say you have $1 million IRA and 50,000 of it, or 5% of it, is after tax. Then for every dollar that you take out, 5 cents would be tax-free and 95% would be taxable. It's prorated. That's the basis of how our taxation system works. So, how much extra tax liability do you have from the RMD? Well, first of all, it's important to understand that it depends on your marginal tax bracket, not your average tax bracket. Another important distinction that a lot of people make a mistake on. Because tax brackets are progressive, as you get more income, they go higher and higher. So if you look at your average tax rate, which is usually what gets published by your accountant when you get your taxes done, it will give you a misleadingly low number. At the end of the day, you want to look at your highest tax rate and figure out what bracket that is to calculate your marginal tax. So if you take a look at these brackets as of 2021 and take a look at the married jointly filing column in the middle, The first 19,750 of income is taxed at 10%. The next bunch of income up to 80,000 is taxed at 12%. Then 22, 24, and so on, as you can see here. And this is your total taxable income. So even if you're not itemizing and your total income is, let's say, 55,000, that would mean if you're married, filing jointly, you'd have to be over 80,000 to get yourself out of that 12% bracket. But let's say you're on the brink. Let's say if your taxable income right now was at 80,000 and now you're going to start taking required minimum distributions. Well, that means all the required minimum distribution money will pile on top of your income because, again, it's taxed as regular income and it will be in your marginal bracket, which means that all of your RMDs in that case would be taxed at 22%. It'll be taxed at that next bracket up. Your accountant might currently be saying this year, hey, your average bracket's about 8 or 9%. You're killing it. Some's at 0, some's at 10, some's at 12. But the RMD would be taxed at 22% in this particular case. And you got to keep in mind, if you live in a state like Connecticut or North Carolina or some of the states I can see here, you guys also have state income tax, which means you're going to be taxed, meaning your total is probably going to be more like 25 or 30% when you throw in the state income tax. So again, you might think, oh, well, that's still pretty easy math, Tim. Why do I need to take you up on your special offer to look at my situation? I don't have any annuities in my IRA. I don't have 401ks. I'm already in an IRA. The calculation's simple. And this tax calculation really does look pretty simple. But again, not so fast. Again, it's the iceberg below the surface. There's this little thing called taxation on Social Security. One of my pet peeves. When we first started getting Social Security benefits decades ago, they were always tax-free. But then they started to be taxed depending upon your income level. And you don't have to have a very high income in order to pay taxes on your Social Security benefits, by the way, just so you know. The taxes are calculated through this very special term that you may or may not be familiar with. It's actually in the IRS code. It's called the provisional income threshold. So here's what they do. They take all of your income sources plus any tax-free municipal bonds that you might have, if you have any. Then they add in 1/2 of your Social Security benefits. If that total is over 25,000 and you're single, then up to half of your Social Security benefits could be taxable. If it's over 32,000 and you're married, then up to half of your benefits could be taxable. So obviously it doesn't take a lot. If your Social Security benefits for a married couple are 30,000 a year, half of that alone is 15,000. That means another 17,000 of income through pension, interest of dividends, IRA withdrawals, or whatever, and boom, it causes some of your other Social Security to be taxed. Now, why is this important? Because if you're above that line, it gradually phases in. So now every dollar of RMD that you take out might be causing you to claim an extra $1.50 of taxable income. It's causing you to claim that dollar of additional IRA withdrawal. But then also it causes a ripple effect because you might have to claim an extra 50 cents on Social Security. So now all of a sudden, if you're that person that's married, couple filing jointly, who's in that 27% marginal bracket, now effectively it's not 27%, it's more like 40%. 40%. And to make matters worse, if you're above that threshold, if your provisional income is above 44,000 for single or married, now up to 85% of your Social Security can be taxed. That means for every dollar you pull out of your IRA, as much as another 85 cents might be taxable. You might have to actually declare $1.85 because of that extra dollar. What makes this a tricky calculation is that it's kind of a perpetual loop calculation. You can't do it just once and for all. So again, that's one of the major reasons that we're offering you this special offer, because a lot of people try to calculate the taxes on their own and you can make big mistakes and then you pay the penalties for it. All right. So now you may be thinking, okay, I need to take it out because the government makes me. I pay the tax. Well, what if I don't need it? What should I do with the money? And that's a very valid question. If you're in that case, congratulations. That's a great place to be, isn't it? You've been living without it up until now. So what can you do? Well, I've got some choices for you. If you're in that type of situation where you don't need the money, you could decide to take more vacations. I've had clients who literally decided at age 70 and a half, or now 72, when they've got to start taking RMDs, that every year they're going to do a family vacation. Once a year, they're going to rent a big house somewhere, invite their children, grandchildren, nieces, nephews, everybody. There's a whole bunch of bedrooms, and they take the whole family and spend it together. They feel that if the government's going to force them to withdraw and pay taxes on it, then why shouldn't they use it to bribe their children and grandchildren to spend time with them? You know, if you can't use your money for that, then what can you use it for? Other people say, no, I just want to build. I don't care how old I am. I want to build. I want to leave a legacy for my family. That's a great option too. They take it out, they pay taxes on it, and they reinvest the rest after taxes in a non-qualified, or in some cases, a Roth type of account. Depends on what's going on and what we're doing, but there are options, and that's certainly an option. Some decide to gift it. They say, I don't want my kids to wait until I'm 6 feet under to benefit from all this money I've got. I want to give them money now, annually, so they can benefit from it now while I'm here. And we can gift up to $15,000 per person right now with no gift tax. So a lot of people want to do that. They want to see their children and grandchildren benefit off that money today while they're still here. Now, what other people do who really want to leave a big estate, a big legacy, and if they're still in good health, is they might go out and buy a massive life insurance policy. And they might say, let me take out those required minimum distributions every year, pay the taxes, and use that to fund a life insurance policy. So now I've got this enormous tax-free pool of money that my children and grandchildren can get when I'm gone. Really leave a big legacy. And there's even other options, but you can see, there's a lot of different options that you can look at if you don't need the money. Once again, it's a great position to be in. But regardless, it's unlikely you're going to die with no money in your IRA, because the required minimum distribution doesn't get to 100% in the account until you reach the age of 115. So it'll go down, but it's not 100% that you're forced to take out until 115. All right. Now you really need to pay attention to beneficiaries in case of death. All right, here are some basic rules with beneficiaries for these IRAs, 401ks, and those type of plans. First of all, if your spouse is the primary beneficiary, he or she can roll the entire IRA into his or her IRA tax-free, nice and simple, nothing changes, real easy, piece of cake, but that's for a spouse. For non-spousal beneficiaries, which literally is everybody that's not a spouse, the general rule is that you have to pull it out and pay taxes on it over the course of 5 years. And with the changes of the Secure Act of 2019, you can now stretch it if you're a non-spousal beneficiary, like a child or grandchild or whatever, and pull it out over 10 years and pay taxes on little bits and pieces over that 10-year period, like we talked about a few minutes ago. It used to be that you could pay that over the course of your whole lifetime, but again, now it's only a 10-year period, because once again, when does the government want their taxes? Sooner rather than later, of course. The other thing that you're going to want to do is check this little detail of how your beneficiary designations with your IRA custodians are spelled out. Now, this is important. This is a big thing. It's per capita versus per stirpes. Let's say you've got 3 children, and those 3 children all have their own children. Now the question becomes, okay, it's great that if you die and all 3 children are alive, they get to split the IRA 3 ways. But the question is, what happens if one of your children passes before you? What happens if there's only 2 beneficiaries living? Does your deceased child share go to the other two of your children? Or does this deceased child's share go to his or her own children or your grandchildren on that side? The answer to that depends on whether you have a per capita or per stirpes beneficiary designation. With per capita, it would go to your remaining children to split 50-50, and your deceased child's kids wouldn't get anything. If you have it per stirpes, then that 1/3 share from your deceased child would go to the grandchildren attributable to that child. So again, there's no real right or wrong answer here. You just need to know which one you have so that you can make sure that it's set up the way you want it. And this is something that we can cover in your personal RMD analysis when we're talking. All right, now let's look at what possibly could be the most important takeaway from this evening, and that is, are your assets allocated for required minimum distributions? And you might think, well, what the heck does my asset allocation have to do with the required minimum distributions? Well, the government forces you to withdraw it. Why should you care? Well, ideally, what smart investors do when they hit age 72, or even in preparation leading up to that, and some shortly after, but they want to ideally satisfy the RMD from interest and dividends, not from their principal. So the government says you have to take it, but they don't care whether it comes from interest or dividends or principal. So if the goal is keeping your IRA intact for as long as possible in later years, most people decide that they want to take their RMDs from interest and dividends and try not to touch their principal. Now, why is that? Well, it's simple. You could get into your mid or late 80s or into your 90s and you could get sick. And you know that you do not want to live in one of those godforsaken convalescent homes. You want to stay in the comfort of your own home as long as you possibly can. We can also look at long-term care options in your analysis. That's a little sidebar. You might want to pay for full-time nursing home care if you're in that situation to help you stay in your home. In order for you to do that, the more money you still have intact inside your IRAs, the more money you will have to stay in the comfort of your home in your later years. And whatever you withdraw to pay for medical expenses essentially is withdrawn tax-free because the medical expenses are a deduction against the taxable income. So that's why most people decide they want to take the RMDs from interest and dividends. Now, what do I mean by that? Let's go a little deeper. Here's an important math equation about investments. It's one you probably already know, but it's worth repeating. Total return equals income plus growth. Total return is what you make on your money. I is the income component that you get from interest and dividends, and G is what you get from growth or appreciation. Now, why is this such a big deal? Well, during the first 20 years of this century, the stock market averaged a 5.58% return. Not bad, right? So you might think, okay, if I've got this money in the market, let's say $1 million in the S&P 500. In the first 20 years of this century, the market went up 5.58 yearly on average. And if I'm just withdrawing, if I'm counting the I and the G, you might think, well, if I'm taking out 4% and I'm making on average 5.58%, my account balance should grow, right? Well, you'll see in a moment that's not necessarily the case. Take a look at what would have really happened over the first 20 years of this century in the S&P 500. This is what I call the if-come method. Because if there's growth and if there's not bad years, then you might have enough to pay you an income for the rest of your life. So let's look at this right here. Let's say you had $1 million in January of 2000. And let's say you wanted to withdraw that magic 4% number that everyone's heard of. You want $40,000 a year income on that, and that's what you plan to do. So you do. 20 years later, you would have had $345,000 left. Only 1/3 of your account. Using the engineered income method or the IFCOM method can be one of the most cancerous financial strategies you could take. Now, let's look at it. How did we only take out 4% and get an average of 5.58% in gains and still lose nearly 2/3? 5 bad years. It only took 5 bad years to totally derail this IFCOM plan. You see, they didn't tell you the whole truth behind the numbers. Let's do another quick math lesson. Let's say you had $100,000 in the market and the market drops by 20%. Pretty simple math, right? If it drops by 20%, 20% of 100,000 is 20,000. So now you're down to $80,000. And most people think, hey, no biggie, right? If it drops 20%, it'll bounce back 20% and I'll be right back where I was. Hold on a second. Let's check the math on that. If you're at $80,000 in the market and you get a 20% gain, where does that take you? Do the math in your head. You math whizzes have already figured out that only takes you to $96,000, not your original $100,000. See that? Now multiply this with multiple years of market losses and larger numbers than 100,000, and you start to see the truth behind the numbers. And many times this happens when you're taking money from mutual funds. You leave your money in 401ks and mutual funds, and you're trying to take the RMDs from there. And here's why. If you're taking these distributions while you're in the market, you're essentially doing something we call reverse dollar cost averaging. And what that means is when you're taking regular income in the years the market's down, you're selling more shares than when the market's up, a greater number of shares in order to get the income that you need or the withdrawals that you need, right? In the years the market's up, you're selling fewer shares. Because you're selling more shares in a down market, you're essentially cannibalizing the fund. Now, the graph right here shows that. This is the opposite of a strategy you might have heard of called dollar cost averaging. When you started saving money when you were younger and everyone said it's a good thing for you to use dollar cost averaging because you're buying more shares when the market's down, they were absolutely right. It is a great thing. But dollar cost averaging is one of those things that's good in one direction, but very bad in the other direction. Dollar cost averaging is good. Reverse dollar cost averaging is very bad, especially in the distribution phase of retirement. Because with reverse dollar cost averaging, you're effectively putting yourself in this position of killing your principal to keep your income stream going. And it's why many retirees run out of money before they run out of years. Now, this is kind of a funny example, but there's a lot of things in life that are good in one direction and not in the other. For example, toothpaste. Toothpaste works really great when you try to take it out of the tube, but have you ever tried to put it back in the tube? Not so much fun, not so easy, doesn't work so well. And that's the issue here. So what do smart people actually do when they start getting near 70? Well, they want to start to transition philosophically from the G to the I, or from growth to income with their retirement investments. Because once you start taking an income, the rules change and you need to change your focus from growth to preservation of assets when taking an income from them. Now, this is what I call the true income method. It's just one of the methods that I work with my clients on. I'm going to show it to you. So if you had that same $1 million still in 2000, and you still wanted the same $40,000 or 4% that we've all heard about, but you wanted to keep your $1 million intact after the 20 years. If you had an account that paid you 4% every year and you withdraw 4% every year, guess what you have at the end? $1 million. And why is that? Because we never have any negative years. This particular account earns a 4% return every year in interest and dividends, and the principal isn't cannibalized at all. So the $1 million is still intact 20 years later after 800,000 in withdrawals. So now, like I said, if you did get sick and you needed full-time care around the house, you have more money to help you get that care when you're home. And the cost of home health care is much higher than the general rate of inflation. It actually doubles about every 12 years, believe it or not. Now, if you don't, and you're blessed enough to die peaceful in your sleep one night, well, guess what? You'll have more money intact for your heirs to receive. At the end of the day, it's better for somebody to end up with the $1 million than to end up with only 345,000, right? And that's why the transition from the if-come method to the true income method is one of the most important transitions you can make as you lead up to age 72 when you're going to start taking the RMDs. Now, real quick in review, let's look again at how you can average a 1.8% more return than 4% and wind up with 345,000 by the end of 2019, like in the example a few slides back. All right, you ready? Volatility. Volatility kills income. You need to ask yourself if it really benefits you to chase returns during the distribution phase of your retirement, or if it makes more sense to protect what you've got. Because really, once you're in the distribution phase of retirement, it isn't so much about what you get, it's about what you keep. Now, I'm sure you still have some questions. I know I gave a lot of generic information, and you might still be wondering, well, how much will my RMDs be? How much additional income tax will I have to pay? Will my RMD creator increase taxes on my Social Security? Is my asset allocation appropriate for RMDs and set up in the best way they could be? Are my beneficiaries set up for maximum tax efficiency after my death, and what are my options there? And these are all great questions, and you probably have some others that relate to your specific situation. And that takes me to one of the last things of the evening, and that's our special offer, the RMD Analysis Pack. Now, in this analysis, we're going to take a look at your RMDs specifically and how much they will be. We'll also check on your asset allocation for optimal RMD taxation and if your beneficiaries are set up for maximum tax efficiency after you're gone. Now, advisors many times charge up to $1,200 for one consultation and to do a custom analysis. True story, 5 webinars back, I actually had a lady that I spoke with after the webinar, told me that she contacted a very famous popular name that most everyone on here would know to see about doing one of these, and she was quoted $5,000 for one analysis. $5,000. No kidding. But since you stayed until the end of this webinar, we're going to offer it to you absolutely free of charge. No charge whatsoever. In the next few moments, you'll have the opportunity to schedule a time with me to do your custom RMD analysis. No obligation whatsoever. It's just to show you exactly what your options are. All you have to do is schedule your analysis now. Don't change the date or time, and this offer will remain complimentary. It's our way of thanking you for watching this webinar and to help you get the most you can out of your retirement. Okay, I'm going to go ahead and launch the special offer now. Now slide out, and there it is. Should be just popped up right on your screen. So essentially all you need to do is click there. It's a very simple process. Just put in your name, couple little things when you would like to meet. You can actually set the date and time on there. Now, you don't have to do a Zoom. You can just do a phone call. You can also do FaceTime. I prefer Zoom because I like to be able to see each other. It personalizes the experience and allows me to see you, you to see me, and allows us to communicate like we're in the same room. But we can do over the phone, or we can do FaceTime, or however you want to get together. But it's very simple. Just click on there, pick the time you want to get together, confirm everything, and we'll be all set. Now, while y'all are doing that, I know I have seen multiple questions come in on the chat box. So while y'all are scheduling your analysis, I'm going to click out over here and go to some of the questions and try to get as many of these answered as I possibly can. I've only got maybe just a little over 5 minutes, so I'm going to get through as many of these as I possibly can. Now, if you haven't already sent me your number one most pressing question, if I haven't answered it yet, send it right now because we were getting short on time. So send that right now in the chat box. I'm going to go ahead and answer as many of these as I possibly can. Okay, let's see here. The first one. Can you take more of the RMD per year than required? Yes, you can take more distribution than is required. RMD means required minimum distribution. So yes, you absolutely can take more. It depends on what product you're in. Some products you can take all of it. Some products you can take 5%, 10%. It depends on what you're in. But yes, that's just the required minimum that you have to take. You can take more. Now, keep in mind, anything that you take as a distribution is going to be counted as regular income on your income taxes. So if you take a whole bunch and it kicks you up to a really high tax bracket, so you got to watch that. You need to look at where your income is at, and then how much you want to take out, because that's going to go right onto your income. And then look at the tax brackets and make sure you're not going to kick yourself up, because once again, that could retroactively kick you down and make you have to start paying 85 cents on every dollar in Social Security, and it can do a lot of things. So just be careful of that. Okay. All right. Next question. Is it wise to roll into a Roth from an IRA non-Roth? In many cases it is. It's hard for me to say specifically. That's why we do these custom IRA or custom RMD analysis, where we look at your IRAs and 401ks or TSPs or whatever y'all have and look at what your options are. In many cases, does it make sense? Yes. Does it always make sense? No. Because everything that you roll over, of course, you have to pay taxes on when it's getting rolled over, and all of that goes as regular income. So there's a lot of things that we have to look at as far as where your income is now, where you are on the tax brackets, what else you have coming in the future. There's a lot of things that we have to put together and look at. But yes, in a lot of cases, it does make sense. But of course, because of course, once you go into a Roth type product, as most people probably already know, in a Roth product, you never pay any taxes on the principal or on any gains. Now, real quick, I don't want to go down this road. We can go specifically when we do your analysis. But in Roth, there's two very important terms that you need to know, and that is contribution and transfer. Sounds the same, diametrically opposed. Contributions are the amount that you can put in cash or that you can contribute every year yourself. That right now for this year, for 2021, the maximum is $19,500. Now, if you haven't done any before, there's something called a catch-up, which can give you a few thousand more, but that's negligible. It's not a whole lot. That's for contributions. For transfers, which is what you're asking, rolling it into, transferring, there's no limitations. So there's products out there that you could actually, in the same product, it's what I call buckets, you would have your pre-tax or your qualified bucket and your Roth bucket in the same product. And every year you can determine how much you want to move over to the Roth bucket, depending on how much you can pay taxes on and how much impact you can have on your income without it really affecting other things all the way down the line. We'll look at that in your individual analysis. Okay, I've got some more questions here. Once again, anybody's got any more? I've got just a couple more minutes. I'm going to get through as many of these as I can. Okay. This one says, my wife is a teacher and she will be retiring next year, and she will get about $17,000 in sick pay. I was told that there is a program that she can put the money into a pre-tax and not pay tax on that money. It's possible. There are different programs in each individual state, and I literally have this webinar going to 26 different states right now. So I can't tell you for sure because I don't know what state you're in. I don't know all of the details. Yes, there's a possibility. There's also a possibility that's not. But if you were told that program, then that program probably is in your state. But that's something that we would look at in your individual analysis when we're going through things. And once again, folks, there's not going to be any pressure. All these individual analyses are is looking at exactly what you've got, everything, how it's going to work, and figuring out what's going to make the most sense for you. Okay, let's see here. It looks like we've got a couple more here. Does TSP fall into the 401 category? Sort of. They're very similar. They're the same exact type of pre-tax product. So yes, they work very, very, very similarly. I've got a lot of clients, a lot of TSP clients that have rolled into an IRA because then it gives them full flexibility of what they want to do. And of course, you know, there are IRA plans out there that still give you a portion of the gains when the market is up, but have no chance of losses. That product exists, and I can prove it to you when we do your customized RMD analysis. I can show you how those products work. Next question. Is it better to take the RMD in the year you turn 72 or by April of the following year? Basically, what you need to do is the year you turn 72 is when you need to start taking the RMDs, and it's going to be based on the amount that was in your account December 31st of the year prior. So hopefully that answered that question. I'm sorry, I'm running out of time, and I've still got quite a few chats here. Once again, if that didn't answer your question, when we do your customized analysis, we'll have plenty of time, and I won't be talking so fast. We'll be able to talk and figure it out specifically for you. But yeah, I'd be happy to help you. Okay. How would an annuity purchased from an IRA impact taxes down the road? Depends on that. That's a wide open question. It depends on what type of annuity that you were talking about. In most cases, if you're transferring into an annuity and it's pre-tax dollars, which I'm assuming that's what you're talking about, because obviously if it was after-tax dollars, there wouldn't be any impact. When you do that transfer, it's not going to have any impact on you at all. It's literally going to do nothing. It's just going to move it from account A to account B. As far as the government cares, it's still pre-tax dollars. They still want their RMDs at 72. They don't care what kind of accounts it's in. So as long as you do a direct transfer, which means you do not see the money, it goes straight from one custodial, that's what it's called, to another, one company to another. You don't touch it. You don't have any tax consequences at all. None. Okay. Should I have my IRA withhold taxes or not? Personal question. That there's different reasons that different things would make sense. It's really up to you, and that's something, once again, that we can look at in your personalized analysis. What's going to make sense for you? There are products out there that will withhold and do that for you, and you can even tell them what percentage you want them to do. And for federal and state. Or you may want to have them not do any and do it all yourself. It just depends on your exact situation and what you're looking at as to what's going to make the most sense. Okay, let's see if I have any other questions here. I think I've about gotten through, and this thing's going to start yelling at me because we've gone a few minutes over. So I tell you what, I'm going to go ahead and wrap up the question section there. If anybody else has any questions, please just let me know. And when we do your customized RMD analysis, we will go through everything line by line, figure out exactly what you've got, what you need to worry about, what's in pre-tax, what's in after-tax. We'll figure everything out so we can know that everything is set for you. Once again, totally complimentary, no pressure, no nothing. We're just going to look, and I'm going to show you what your options are, what you want to do from there. Totally up to you, but that way at least you'll know what your options are. Okay. Let's see. All right, I'm going to go ahead and wrap this up. I want to thank you for watching the webinar, and hopefully I answered most, if not all, of your questions. Again, my name is Tim. My company is The Plan Advisor, and you can reach us anytime at theplanadvisor.com. Now, there is a ton of resources on that site. Okay, you could literally spend hours on that website learning about what you need to do for retirement and how you can plan a safe money retirement. One of the things you can do is my podcast, Safe Money Retirement Radio. I don't know if you listen on basically any platform, whether it's iTunes, Amazon, Google, Spotify, wherever you listen to any kind of podcast, just search Safe Money Retirement Radio. I've got dozens of episodes of podcasts, and they're all talking about this stuff we've been discussing, how these products work, how safe money products work that can protect your principal, still give you gains with no chances of losses, how those products work. You can get a ton of information. If you don't have a podcast player, just go to my website, The Plan Advisor, or you can go to safemoneyretirementradio.com. Either one will get you right to the podcast, and you can listen to it right there. Now, I also have copies of the Safe Money book, and I will send anybody a copy of the Safe Money book that would want one. So just let me know. The best way to let me know if you want a copy of this is shoot me a quick email, tim@theplanadvisor.com, with your address. Be happy to send you a free copy of the book. Explains how all these things work. Lastly, as a certified financial fiduciary, I am obligated to work solely on behalf of my clients and only in their best interest. So here's my last piece of advice for the night before I close out. Whether you work with me or you work with someone else, I strongly recommend a certified financial fiduciary for your retirement planning, because they will work solely in your best interest 100% of the time and not in the best interest of any company. All right, I'll tell you what, I'm going to leave this open for just a few more moments because I see several of you are still scheduling your analysis appointments, and I want to make sure everyone has a chance. So if you're in there, finish it up quickly. I've got about another 30 seconds or so. If you accidentally closed the pop-up window, or if it didn't come up for you for some reason, just go to my website, theplanadvisor.com right now. Go to the schedule appointment page, and you can see a little thing there to book your complimentary RMD analysis. You can click it right there, and it literally is the same thing as clicking this thing on the screen. Or if you'd like someone else to see this webinar, they can view any of my past webinars, or this one will be on there by about noon tomorrow at safemoneyretirementwebinars.com. All right, I think that's about it. Thanks again, everyone. I look forward to meeting with you all personally. Thank you so much for your time. Once again, all veterans, thank you from my heart. Thank you so much for all that you've done, all that you've sacrificed. Happy Veterans Day. Hopefully we got a lot of your questions answered, and I look forward to meeting with everyone in the very near future. God bless and take care.